1.2 million of mortgages in Canada are coming up for renewal this year.
1% of the population of Canada, that's quite a few people that are in trouble.
Selling the house, realtor fees, land transfer tax, lawyer fees, are you going to come up? When the tariffs come in, it's going to be a one hit of the inflation. What? That's the biggest question of all, right?
Eric, welcome back.
Thanks for having me.
So last couple of times we sat down, we talked about mortgage rates, what's going on with Bank of Canada. We typically always talk about, what do people need to do when they're looking at buying a home? And I'd look a lot about the resale side as well, but I think one thing that I don't really follow as much, that'd be great for you to talk about, would be the renewals.
Yeah, renewals, crazy. It's going to be a crazy year. 1.2 million of mortgages in Canada are coming up for renewal this year in 2025. So it's going to be interesting to see how it's all going to play out. 85% of those mortgages have a rate lower than 2%. So yes, we've seen some good rate cuts from the Bank of Canada. The bond market's been going down, making the fixed rate, some of the rates are starting with a 3, which is very, very positive. But it's still going to be some type of a shell shock for a lot of people out there. If you didn't follow the news and you're not expecting it and you're not putting stuff aside, it's going to be quite the shock for you. When you're doing a renewal of a mortgage 500,000, when you were at 1.79, your mortgage payment's 2,000. Now with the higher interest rates, if you're calling 4.25, you're looking at $2,650, $2,700 a month. So $650, $700 extra on somebody's budget who is already tight as it is. It's a tough pill to swallow. There are some things that the banks are doing to help. So if you're on a 25-year amortization, you can go on 30 and possibly save yourself that $200, $250 extra a month. You take it for a short term until the rates come back down, and then you're able to move. So there are a few things that are happening, but it's definitely going to be interesting to see how it all pans out. And I've got a few things graphed for you just on that alone to sort of explain to you how the renewals might affect certain people that are with the big banks right now. So when you're talking about, and this is going to be this graph mainly on variable mortgage, so people that took variable in 5 years ago. Certain banks, in order to keep cash flow positive, they don't change the payment for you. Okay, and what they do is they change the amortization period. Okay, so that means that you've been paying the same thing from day one to now, but now you're coming up for renewal and your amortization is through the roof.
Yeah.
Okay, so I've seen some at 60 years. I've seen some at 52 years, 48. And that needs to be brought back to 30 years, meaning that your payments are going to go up, right? Not every lender does that. Most of the lenders that we work with do not do that. They will change the interest rate the month after. So if it goes up, your payments will go up. If it goes down, your payments will go down. Okay. But if you're looking at the graph here, you're going to see that some of the major banks out there, if you're looking at this side here, is 35 plus. So 16% of the $437 billion that RBC has in mortgages, 16% of those have amortizations greater than 35 years. Okay. When you're looking at TD Bank, it's 13%. Scotiabank at 0.3 because Scotiabank actually changes the payments. So you're not going to see that much. You got BMO at 16. You got CIBC at 17. Again, National Bank doing the same thing. And Desjardins is a mix of both. Okay. So out of these people that are here, the payment change will be greater than the $700 that we were talking about now on the fixed rate mortgages, just renewing with a higher rate. It could be drastic. It could be upwards of $1,500, $1,600 difference on the mortgage payments.
From a mortgage payment that was at $2,000?
Yeah, like depending on your amortization, right? So if your amortization is up to 55 years, you got to bring it down to 30. It's a lot.
Yeah.
It's 25 years, right? So you're going to see market reaction when it comes down to this with all the renewals, not everybody's going to be in the same boat, but a lot of people are going to be in a position where they're going to amortize to 30 years. So they're going to make the payments smaller, but a lot of people are not going to be able to afford it. So what that means for the market is there going to be an up in foreclosures? Is there going to be an up in defaults? We've already seen an up in 2024 from 2023, and the predictions is that we will see an increase in there as well. Luckily, when you're looking at the graphs of the people that have mortgages, they're in a better financial situation to be able to absorb the higher payments. So typical lenders, banks, I'm not foreseeing a lot of those situations happening. I mean, the default rate's at 0.2% right now, and just to give you a perspective, when the United States had the crash, it was close to 11%. So we're far from that. It's not to put a negative spin on it, but it's more to educate the people that, you know, there's a lot of mortgages that are coming up for renewal in the next years. So here's the next graph, which will give you the renewal rates and when the renewal rates are coming. So all mortgages, you can see 2024, you know, about 22%, and then it climbs up to 2026. The red is variable mortgages with variable payments. So the ones I was talking about, like if the interest rates go high, then the payments will change. And then you've got variable rate mortgages with fixed payments that the interest rates does not move. That's in the green. So you're going to see 2025 and 2026 have a big chunk of those mortgages. And then after that, you'll have the fixed term, less than 5 years, and then the fixed terms, more than 5 years or more, that are coming up for renewal. So a lot of the mortgages are coming up for renewal. If you're calculating, you know, 22%, 25%, and then 30%, put them all together. Yeah, that's 80% of the mortgages are coming up for renewal from here to 2026.
Yeah, and based on this graph, like the green represents the people who are in trouble, where their payments are actually going to go up.
Correct.
And so this year and next year is where we're going to see the most of them renew.
Yeah, those are the people that have higher amortization. Now,
Yeah.
a lot of people saw that coming and decided to switch their payments to make it work. A lot of the banks did contact them. A lot of people couldn't afford it at the time and are just, you know, postponing the shell shock that they're going to receive once everything moves up, right?
Yeah, because I think if we look at just the all mortgages, we're not seeing too much more, you know, this year than the last 2 years. But
Correct.
what's really the difference is that the variable rate with the fixed payments, so the people that their payments are actually going to go up significantly, is increasing this year.
That's right.
Anyone on the variable in the red, like they were already taking the hit the last few years, right? So it doesn't really matter that they're up for renewal because they're just renewing at the same thing or at a fixed rate.
That's right.
Yeah.
So what happens in that type of situation also is because your fixed payment is low, you're putting less and less and less on the principal, right? Because you're putting less on the principal, your mortgage amount does not move. Okay, so if you're somebody who bought at 5% down payment 5 years ago, typically on a normal mortgage, you would have about 10 to 13,000 in principal that would go every year. You lost that, right? So to be able to switch mortgages or take out money to compensate for that difference or put it on a longer term, it makes it a lot harder because you don't have equity in the home, right? And ideally, what you're going to say is, well, I put 5% as a down payment. I can't afford these payments anymore. I need to sell the house, right? So you sell the house. Let's call it a $500,000 home. You put 25,000 as a down payment, so 5%. Your equity, you probably saved equity about $15,000 in there. But then you have the CMHC fee that comes into play. So let's call it 500 even on that. And you put 25% down. Selling the house, realtor fees, land transfer tax, lawyer fees. Are you going to come out on top? I don't know. It's going to be tough, right?
For sure. I mean, it all depends on when you purchase, right? But at least for sure, if we're talking about someone who purchased in 2020, um, who's up for renewal today, like that price has gained quite a bit of
Of
equity if we're
course.
just talking about in general.
Yeah, exactly. The mortgage probably stayed the same, but the home price went up for sure,
Yeah,
which is very helpful.
for sure. And I mean, I think that would be my bigger concern looking at people next year. Because 2020 is when we started to get bidding wars, but even if you were, called overpaying for a home in 2020, you've still seen a lot of equity.
That's right.
Whereas maybe if you bought a home in 2021 or early 2022 in a bidding war where you pay significantly high, that is where you might not see the same financial gains, or you could not see any, right?
Exactly. And that's the highest
Yeah.
portion right here, right? So
Yeah, so I definitely, yeah. So I think the people dealing with this year is going to give us a good understanding of what to expect next year. But just based on if we're looking at that numbers, and I wish I would have had my numbers, but this is great. I'm kind of learning it all for the first time right now. I think, yeah, this year will be a little bit of a test year to see how those people handle it, because a lot of them will still have the equity. But next year would be, you know, if we don't see the prices increase significantly this year, might be more of an issue. But we're also looking at maybe seeing the prices increase this year with interest rates continuing to go down. And that's the other thing too, right? Is what are the interest rates going to be at next year?
mm,
Is their payments going to change that drastically?
that's the biggest question of all, right?
Yeah.
But interesting to see what's going to turn. The banks have made some changes to the renewal process, where if you're renewing from one institution to the other, you don't have to go. You don't have to stress test. You don't have the 2% above.
Mhm.
That allows the clients to shop around more and get better rates. So that's good for the client there. And when we qualify our clients, also we qualify them at 2% above the rate that they're getting. So, or in this case of 2021, 2022, we had to qualify them at 5.25 regardless.
Mhm.
Okay, so the debt ratio, the income that was used at the time, was very comfortable at 5.25. So now that they're going 4.2, I mean, it should be fine. But a lot happens in 5 years, right? You change position, you lost your job, whatever the case is. We'll
Mhm.
see. And that's the other one, right? The unemployment situation that's coming. If we have a change in political parties that is showing that there's going to be cuts in the federal government, all these tie into the affordability of the people that are going to be renewing at the same time, right?
Mhm.
So hopefully the rates do come down and help these people. But again, nothing to worry about in this type of situation. We're still at 0.2%. It will rise slightly, just to give awareness of what is happening, and it is happening to certain people where they're having struggles with the payments.
For sure, I'm seeing it. Yeah.
And like, just me, in the past month, we've had calls, and you're gonna see like these numbers that we're talking about, the 0.2. These are all based on information by the Bank of Canada, given by Equifax.
Hmm.
Okay, not every lender reports on Equifax. So if you're on the private side, a private lender will not. He'll put a lien on your house, but he won't put it on your Equifax credit report. So those numbers is what's the interesting number. There's no way of getting those numbers,
Yeah.
but that's, I think, where we are going to see more mortgage default delinquencies come up more on the private side.
And so why is it that they don't put a hit on people's credit? Why is it just the lien covers them enough? It doesn't.
The lien covers because these private lenders lend, mainly on the property,
Mhm.
not on the client itself, right? And some people go and overextend themselves. Private loans, interest rates are high. There's fees that are tied to that. Sometimes they go closer to the 85% loan to value. So
Mhm.
if somebody doesn't have the full down payment, or just to help those people out. But, with us, every time we have a discussion about private loans, we want to have an exit strategy. This is a short term,
Mm,
1 year max. What is going to happen after the 1 year? How are we going to get you out of here?
mm,
And we have those conversations with the clients. And if it's not a feasible plan, then it's not time to buy.
mm,
Just plain and simple, right? Um, but yeah, it's going to be interesting to see those numbers. And just like I said, I was saying, in the last month, I've had 3 calls of clients that are in private mortgages, that are facing foreclosures, that want a solution until they're able to sell their property, just to give them that buffer of time.
mm,
Obviously they make the call to us way later than they should. So
mm,
we have to act fast and try to find solutions for them so they don't lose their house, they don't lose their down payment, they just don't, just let it go as is. But yeah, it's tough. I mean, these private loans that are out there are there to help certain people. But on the downside, most of those loans are all interest only. So you're not even putting any capital. You're just paying the interest.
mm,
It lowers your payment, mind you,
mm,
but interest only. So at the end, when you're facing renewal, or even if you're having a hard time with the payments, you can't even refinance the property because there's no equity in it.
mm. Yeah, I know. I think you just brought up something that I would like to speak about for sure is people who are in trouble waiting too long to make that call. Because I've experienced that many times, a few times, in the last year, where people have taken out multiple loans. They do know that they can't make the payments, and they don't say anything about it until they already get the letter from the lender saying, we're taking back control here, right? And at that point, they call me to try and sell the house. But we got to realize here that it's the real estate market has a lot to do with timing. And so, if we're looking at a market that happens to be slower at the time, right, where there is competition that isn't selling or whatnot, and we got to look at the time it takes to get the house ready to go to the market, the time that it takes us to be on the market, and the time that it takes the buyer to close on the property,
Yeah.
right? A lot of these people could save themselves a lot. Like I unfortunately had to turn down, a few people this year and let them know that I couldn't help them because uh, I saw that, based on what they needed to do with the property to get it ready and the timeline they had and the money they needed to get out of it, it just wasn't feasible,
Yeah, it just didn't work.
right? And so, whereas, unfortunately, if they would have reached out to me sooner, then we could have helped them,
Yeah,
right?
100%. And
Yeah.
it, everybody that's in, and we see it all the time, anybody that's in a debt situation, they don't push it under the rug, but it's a stress, right? So
Mhm.
they're trying to relieve the stress by not thinking about it, right?
Mhm.
And they just push it until the last minute where, like, now I need to action this. And most of the times it's too late, right?
Yeah.
So it's tough. So it's going to be interesting to see what the numbers are for delinquencies. In 2022, private loan delinquencies were at 2%. Now they're at 9. We haven't seen the numbers for the last quarter of 2024 or the beginning. They usually do quarters, so we're a little early in 2025. But it's going to be interesting to see what that number is going to be. And I'm ready to say it's going to be significantly higher than the 9% that it was,
Mhm.
maybe an 11, 12, 13% range, right? So yeah, it's happening.
Mhm.
So we can't look away from it.
Mhm.
But again, it's a small portion of um, the market, right?
Mhm.
So private loans out there, if you're looking in Canada, you're probably looking at around 15% of the homes that are out there that have a private loan on them. So it's not significant, but it is happening, and it's happening here in our city, right?
Mhm.
So things to think about, especially with the renewals coming. Hopefully, it doesn't go up too much, but
Okay. So, I mean, just really rough math in my head, and maybe I'm way off. You said that the normal banks that were at how much in delinquency, or the 0.2 or 2?
So everybody in Canada right
Yeah.
now is 0.2%.
0.2%. But then what we're talking about, not talking about private loans there.
No, no,
Private,
no, no private loans. On the private side, it's 2%. Always higher because it's
yeah,
riskier, right?
yeah.
And now 9.
Okay, and then they're about 15%, so it's probably maybe 1% of Canadians then,
Correct.
if that falls into
Yeah, that's a good math.
10% of 15%.
Yep.
Yeah.
Good math.
Okay. Yeah. So I mean, yeah, but even then, I guess when you do 1% of the population of Canada, that's quite a few people
It's a lot of
that
people. Yeah.
are that are in trouble.
Yeah.
Yeah. Okay.
So it's happening. It's happening in our backyard. It's sad to see. It's the realistic, of what's happening, and we're trying to help them as much as we can. But again, sometimes a little too late to the party, right?
For sure. I mean, like that's where I come in on these sides of things too, right? Is looking at for sure interest rates, and a lot of people haven't paid down the equity, or if they've actually, for example, they bought the house for 550, but because they remortgaged it multiple times, they owe 650 on it.
That's right.
Where that 60 sale price is possible, but it's not possible in the short timeline
Mhm.
that they put themselves in or whatnot, right? And so that, yeah, for sure, that's repeating myself, but definitely, for anyone who's watching this, I'd say, if this is you, right, if you are underwater, um, act now, right? Start to ask the questions, start to see like what you can do to prepare your house, because there's definitely ways that you can still walk away with money in your
Yeah, of
pocket,
course.
especially with the market that we're entering right now, right? You take a look at this graph of having the high percentage of mortgages renewing in the next couple of years. When we look at the amount of homes that sell, right? Like we have 50% of homes that sell in the next quarter,
Hmm.
right? Like the next 3 months sees 50% of the
That's
homes
right.
sell in the year, right? So there's like now is the time to act and get in front of it. But say if you're starting to get underwater now and you wait those 3 4 months and then the bank calls you and you're now in June
Hmm.
and trying to get a quick sale, like that is when you're putting yourself in trouble
Yeah,
and you're possibly losing the place.
100%. And when we're talking about the foreclosures, the defaults, it's not just people overextended themselves and they can't afford the payments. There's a lot of life activities that come into play, injuries, sickness,
Mm-hmm.
all that comes into play. I had one the other day. She owes about 700,000. The house maybe 800, closer to 750. She got injured, couldn't do her payments. She's been in arrears. So it's not that she bought and she had a mortgage. She bought for 750 and she had a mortgage of 700. That's not the case. The mortgage was a lot less, but because she got injured, she missed payments, and then it just adds up from there. And then there's interest on top of that, higher interests, and so
Mm-hmm.
there's a lot that come into play. So I'm not trying to say that people that are overextended themselves, they can't, they shouldn't have done that.
Mm-hmm.
Now they're over their heads and it's their own fault. No, it's not. Like we got to be very empathetic on those situations that life.
Life happens.
Yeah, life happens. Life situations happen. So we're there to help, but just don't wait too long when it comes down to it. The next point, that I wanted to bring is not only on mortgages, but I wanted to sort of bring an insight as to, yes, it's happening in the mortgage world, but it's also happening in different aspects of businesses as well, right? So got another graph for you. So, okay, so this is consumer loans that are in delinquencies that do not include mortgages.
Okay.
Okay. So if you're looking at the bottom, you've got people that hold mortgages and people that do not hold mortgages. Okay. So
Okay.
auto loans for mortgage holders on the light blue there, you see that bottom line.
Mm-hmm.
Credit cards with mortgage holders, you sort of see that orange line.
Yeah.
So when I was saying earlier, the people that have mortgages are in a better financial situation to be able to take on these extra payments.
Mm-hmm.
This is sort of the graph I was referring to. The auto loans of borrowers without mortgages is the red that you see up there.
Yeah.
And then you've got credit cards from borrowers without mortgages. So,
Yeah,
which
this is
is
auto loans is
the
the
heavy
blue
blue.
and the credit cards is the red. Yeah. So basically, the people without the mortgages have their debt increasing at a higher rate than people with mortgages.
Correct.
Yeah.
And that's due to, there's two things, right? Rent pricing, has increased.
Yeah.
That's number one.
Yeah.
Number two, inflation. So cost of living everywhere.
Yeah.
Food, anything really, gas,
Yeah.
whatever you want to say, and cars. Think about the cars. Think about that car 5 years ago that you could have bought for 40 grand, which is now 65,
Yeah.
right? But again, so that comes into those loans too, right? Where you're going into, you need a car. You're going into an affordable dealer to get your car, but it's still very expensive, right? So maybe those payments are not affordable. The interest rates definitely play a big factor in there on financing the car. At some point you were at 6, 7, 8% for a car loan when 5-6 years ago you had advertising at 0.99%, right? So
Yeah, I guess you're most likely more susceptible to take on heavier debt because you don't have a mortgage payment.
Mhm.
So you're more
Yep.
willing to take a heavier debt
Yep, of
on
course.
something like a credit card or a car loan. Yeah, for sure. I mean, definitely my wife and I bought our cars right at the switch as well. We ordered them in 2022 before the interest rates came up, because at that point you couldn't, like, a used car was the same price as a new car,
Yeah, that's
right?
right.
Because you couldn't get the new car.
That's right.
So we ordered them in the very beginning of 2022 before the interest rates went up, but we didn't receive them until the summer of 2022
Now the interest
when the
rates.
interest rates were already up and the used car market started to drop. And yeah, that ended up being, we found out that the most appreciating car of 2024 was her car.
Nice.
Yeah, so I mean, it happens to all of us, right?
So yeah, all to say, like, the graphs is, it's not just the people that have mortgages that are struggling. You've got everybody out there, obviously. But when you're looking at the economy, there's a lot of uncertainties coming. Our inflation is at 1.9%, below the 2% mark that we wanted. So that's looking good. Unemployment is something that we're really watching, which in January actually went down a little bit. But the forecast is that it's going to increase. So we're watching that closely as well. And the change in government, is the Conservative going to take over? What's going to happen there? What are they going to do to help housing? That's another one. So a lot of uncertainties. The tariffs.
Yeah.
If the tariffs come in, what's going to be the reaction of Canada when it comes down to helping Canadians? And trying to limit the impact that it's going to have on the inflation, right? The funny part, when the tariffs come in, it's going to be a one hit on the inflation. What?
If.
Yeah. Yes.
Yes.
But when? But if.
Yeah.
It's going to be a one hit on the inflation. So it's not like it's going to keep increasing. You're just going to see that first hit, and then you're going to try to manage it as best you can, right? So until we see that number, who knows what's going to happen. The predictions of last time when we spoke here, the predictions on the interest rates that the Bank of Canada was going to cut 1.5% a rate in 2025. They've already started. Is it going to be still the case?
When's our next rate cut?
Early March.
Yeah.
Soon. Yeah.
I thought so, yeah.
So it's going to be soon. I think with the uncertainties, I don't think we're going to see a move there. But if they need to boost the economy a little bit and stir the pot a little bit, you're going to see some reaction to that, and you're going to see the bank making moves. But we're not off on the 1.5%. I think that's the high point, but it's going to be between 1 and 1.5 is going to be the decrease there. And then when we're looking at the bond market, I'll pull it up just because it's interesting. I know we talk about rates all the time, but it is an important watch to see what's going to happen when that happens.
Yeah, so I mean, I guess actually I want to ask something too, to clarify, because we were talking about delinquency payments, right? Like that's what's going up to 9% and possibly more in the private. Do you know the numbers on foreclosure?
No. So when we're talking about those numbers, and the foreclosure numbers are not even anywhere to be found. because of the private companies, right? But when we're talking delinquencies, we're talking missed payments over 90 days.
Okay, so those majority are most likely making foreclosure.
Yeah.
So okay, so we're talking about the same. All right.
So having a look a little bit on the bond market, we're going to see the bond market at 2.61. Now, for everybody, this is basically it's mainly for the fixed rate. So this is what we look at when we're looking at the fixed rate and seeing and that's how we're able to predict the rate's going to go down next week, in 2 weeks, whatever the case is. So we have a look at it. So right now we're sitting at 2.61% on the bond rate. Usually you're going to have a 1.5% above that. So this is the cost price that the Bank of Canada, the lenders buy it from the Bank of Canada for. So 2.61, and then they add their percentage on top of that. Usually it's 1.5%, which right now, when I was talking, you're seeing some threes in front of the number. For 4.24 or something like that. So it's a little less than the 1.5%.
Yeah.
But pretty close. But when you're looking at the last, let's do 3 years here. Okay. So we saw a big decrease here, which was the biggest decrease we've seen in 2024, which was 2.71. And then we saw a slight decrease at 2.72. This is the lowest we've ever seen since
Briefly in 23, right?
you know what I mean?
Yeah.
So interest rates are going down. You're actually gonna, I don't know where this is gonna air, but you're actually gonna see some movement in the next couple of days or early next week on the interest rate. But so we're watching it. So it's nice to see that it's coming down again. What happens on March 4th when Donald Trump decides what they're going to do, that might have a big impact on that bond and sort of keep it steady. So I think everybody's status quo right now just to see what's going to happen. But yeah, it's going to be an interesting renewal period.
Yeah, I'd say so. Definitely on the real estate side of things, like we saw the market heat up significantly. I think the weather the last couple of weeks here didn't help in Ottawa.
Kind of hurt, yeah.
People stuck in their homes, but I'm definitely expecting to see March, April, May be the biggest we've seen in the last couple of years.
100%. So we talked about the renewals. We talked about the semi bad of what's happening. But when you want to talk positives, I think this is going to be a big year. I think those March, April, May, June, I would even go into are going to be some big months in the market. You already saw at the beginning of the year where it was creeping. You're right. The snowstorm, all the snow, everybody all of a sudden just let's wait a little bit, and the interest rates are going down. So when you're able to get a 3-year fixed at 3.85, 3.87, is becoming way more attractive than having a 5 in front of that number. And let's not forget too, once you get to that rate, that's the qualifying as well, right? So not only are you able to afford more, or you're able to, that helps a lot as well. So the people that were in the 450 range now are being able to go into the $500,000 range. That helps them getting into the market as well. So that's interesting to see. So you're going to see a lot of first-time home buyers come back into the mix. We've already seen it at the end of last year, and it's just going to trickle through. So you're going to see a lot of first-time home buyers come back into the mix, and the people that we haven't seen in a long time too come back in the mix. Investors, right? So people that are buying investment properties now are coming to a point where there's no shortfall, or there's close to no shortfall on a purchase versus rent, right? So you're going to see that have some impact on the market.
For sure. I mean, investors definitely, like, we're seeing interest rates go down, or payments are going down, but rental rates have significantly increased, right? So definitely there's a huge opportunity for investors who see that coming and jump in before things change on that
Yeah,
side for sure.
100%. I think, and you can speak on that one. What do you think? Like right now, we're in low inventory, right?
Yep. For the
And
most part, it
for,
depends. I mean,
depends on the market
if we're talking
and
about
where.
condos, we're definitely not talking about the same
No,
market,
no, for sure.
but on freehold homes, we're in a lower inventory
So, are
for
we
sure.
forecasting a big increase, or is it going to be?
And inventory,
Yeah,
I mean, that's the thing. It all depends. But right now, we're not seeing that many homes hit the market. And definitely there are some areas where there isn't any homes available. Right, like I was even just looking today in Barhaven at condo townhomes. Usually those are pretty easy to find.
yep, nothing. Eh?
There's not really much going on, right? So there's definitely different pockets of the city, different like property types that there's tons, right? Like there is, there's certain areas where there's tons of single family homes available, right? But for the most part, when we're looking the lower price points, for sure those are flying a lot
Yeah,
more.
of course.
When we're talking about freehold or like condo town, stacked homes, that kind of stuff. What we're seeing not move too much right now is the apartment building condos. Seeing it quite slow across most buildings in the downtown core right now. So we'll see what happens there. That inventory is rising faster than the sales
Okay.
for sure. But
Is
but
that normal for this time of year, or is it just like
yeah,
it's normal for this time of year, but not that high? Is
the condo market's always been hit or miss in Ottawa, right? So the condo market's typically been slower because until a few years ago, you could buy a home.
yeah.
You could buy a freehold townhome, single home for under 500K. And so, what was the need for a condo at the same price, essentially? Um, then, when we saw the market prices really go up, you see obviously demand for condos go up because that's what people can afford.
Mm-hmm.
But right now, I think we saw a lot of investors get into the condo market here in Ottawa too, right? A lot of investors from Toronto, places like that.
Yeah, Toronto is a different.
Exactly, right. So, and they're seeing the same thing, right? I
Mm,
think the Toronto market's seeing a major change in that too. So for sure, I think we will start to see more movement coming. But right now, that's the market I would say that has the most inventory and where things aren't moving as much. But most other places in the city, if a property is marketed well and priced well, like
like,
it's potentially even selling at multiple offers.
that's nice.
Yeah,
So yeah, good for the sellers for sure. So yeah, like a lot coming in. Increase in market renewals. Are people going to want to move to bigger places, or are people wanting to downsize? I mean, there's going to be a lot of movement. It's going to be good. It's going to
for
be fun.
sure. Man, I learned a lot, so thanks again.
No problem. My pleasure.
And hopefully we'll sit down again soon with some more updates.
Sounds good.